Interesting. Screen off. So just some things. All right. Interesting with interesting thing about live video. So my name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues my championing of closed-end funds as a great investment strategy. If you want the full methodology and our 12 steps to financial freedom, then head over to Facebook and check out my group there called Navigate Your Finances, where I give you the entire framework for free. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. It's kind of like the calm before the storm in the Houston area as we wait for the hurricane to arrive. And then my family's watching Shark Week in the background. So who knows what you'll hear. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So let's start with why I like closed-end funds so much. You get discounts, crazy discounts, and you also have the ability to pick fantastic dividends, like 8% plus monthly paying dividends that, I mean, for the most part, are on the rise. You get opportunities across every sector. You get low risk, and you get much better payout compared to single stock investment. You get improved upside as those discounts close, and then you get access through various accounts and platforms, meaning closed-end funds are not isolated through one investment platform. You can get them like we do ours through Webull. You can find them on your investment guys board, and they work in various accounts. Like we have an individual brokerage account. We also have a Roth account. So they're not limited. They're readily available. And as we look at the market, the surface of the market hasn't changed much over the past 3 to 6 months. I think we're starting to better see the market hiding in the shadows, or at least we're better able to define that shadow. The the S&P, like those jumps we've been seeing, the S&P isn't just 500, it's really 503. And the top three of that, or at least of what Slick Charts has in their let's see, of what Slick Charts has in their S&P 500 ETF list, it's really 503, with Microsoft, Apple, and Nvidia topping that list. And those three are really skewing the data on the rest of the market space. Michael Kramer, like I just read an article from Michael Kramer with Mott Capital. He said it this way: the rally is nothing more than a handful of names. It's really the same 3 to 7 names continuing to push the overall index higher. And in that seven lot of names, it's all tech and AI. And depending on who you listen to, some people put those in different categories. It's really the same thing, but more money is pumping into tech and AI than any other sector, which means there's a bunch of ignored corners in the market, which translates to great deals if we know where to look. And if we look at the data and not just the top three data, the market at large is either slowly entering a recession or quickly sliding into recession. At least that's been the sentiment across the board. Let's see. Like I have an outline of things I want to talk about, but it doesn't always work in how I actually say everything. So before I get into what Investopedia says about recessions, think of this. Consider inflation. Inflation and record inflation curbs spending. Now, it might not curb the amount you spend because your dollar is worth less. You're not as able to buy the same amount you were buying. So you're still spending $300. You're just not getting as much as you could for $300. Okay, so now Investopedia says when consumers cut spending, there's less demand for goods and services that companies sell. So companies manufacture less, and may trim their service offerings. But making fewer products and offering fewer services also means companies need fewer employees. And so we often see layoffs. Now, we've kind of seen the former. People aren't buying as much, but we are still spending as much or more because of inflation. But we haven't seen the latter, where we have not seen a ton of layoffs. We initially saw a lot of layoffs at news companies, but I think that's a different thing. Uh, and I've said, I mean, me personally, I've said for months that we're in the lead up to a recession. But one of my favorite strategists just made a case for us moving beyond the recession mindset. Like maybe we were already in the recession and now we're slowly coming out of it. Michael Foster works alongside or works within the contrarian outlook, and he makes a strong argument for stocks instead of bonds. And you can find his full advice in a recent article titled "Inside the U.S. Economy's Stealth Boom." And if you type that into Google, it'll pop up the free version of that article. And inside that article, he makes 3 points. One, more Americans are working and spending money, as well as building wealth and spending more. And I would say you cannot both build wealth and spend it. You end up break even or broke. I mean, if you spend your wealth, but you can make more money and spend that. So if more Americans are working, then more Americans are making money. More Americans are spending money. Okay, but you wouldn't know that because the overall take-home money is getting eaten away from inflation. Two, he says, since the pandemic, most keep their wealth in cash, and there's trillions of cash hanging out in money market accounts. He also says the idle cash is bullish for stocks because stocks rise when inflation goes up, but stocks haven't risen much in the recent bout of inflation, and things are just now starting to recover. And from my standpoint, and I think I'm focusing more on terminology than anything, it's wealth, savings, and retirement can be different things. So since the pandemic crash, many people have opted to keep their savings or retirement in cash. I don't know why, because that seems like a very fearful thing to do. Your money stored in a basic savings account is not earning much money. Your money stored in a money market account might be earning 4 to 5%, but inflation is, if you believe the Fed, inflation's at 3.4%, and so your money's not exactly helping you. If you believe the Fed, it's barely growing, and if you don't believe the Fed like me, then it's not growing at all. Right? So when we get those crashes, instead of socking away that money in a retirement account or money market account that's not going to earn you a lot of money, when the market crashes, you scoop up deals in stocks and bonds and real estate, and then you find solutions to people's problems, and that's how you really grow wealth. So, number three, Foster says that professional investors have been piling more into stocks than real estate because the cost of owning a home in a high rate market isn't cheap. And he thinks the herd will follow suit and bring all that money market money with them. But honestly, just like the herd does, they're going to follow these professionals into single stocks and shoddy gains. And while the herd follows those little bell ringers into oversold stocks, we can do a lot better in the closed-end fund market space, right? So according to Foster, the labor data is potentially better than anticipated, which is great for the country. But the herd doesn't seem interested, and that's good for us. Their tunnel vision on tech presents us with some very good opportunities away from direct tech investments. And yeah, I mean, it's raw video, so you get to hear me make all these stutters and misstatements. So direct tech investments, from my angle, would be buying single stocks of top five, top seven, however you want to say it. But Microsoft, Apple, Nvidia, Meta, Google, Amazon. Pick your tech giant. And while the herd looks at direct tech investment or the S&P top 5 or 7, we can snag steeply discounted closed-end funds whose portfolios have strong stocks with consistent cash flows. And just of note, the S&P 500 on average currently generates 1.5% yield. The normal average is 1.8, and that's like bottom of the barrel. That's piddly compared to what we can get in the closed-end fund world. So if we look beyond tech, what else is impacting the market? Well, you still have the Fed. You have the Fed controlling a lot of things, and they're going to continue to control a lot of things until the system changes, if it ever does. So supposedly inflation is at 3.4. You and I know that's off because the data says otherwise. And we also continue to see slight increases in that core inflation data. We also haven't seen any drops at the grocery store. So the easiest explanations to the Fed's doublespeak, like the economy's great, but inflation's rising, or the economy's great, but our everything costs more. They're either printing money again, and they are, or they're lying about the overall health of the economy, and they are. So, kind of as an aside, did anybody think the Fed would raise rates in an election year? Not me. Though I did hope they would drop rates sooner than later. I mean, I get it. They want to look good. They want to keep their jobs. They want to keep the power. But the trouble is they're printing money and causing those small increases in inflation. And as a result, we're getting hints of stagflation, which would be a supposedly improving economy with sticky inflation. So where does that leave us? Overall, you got to see the big picture. You got to do your research and not trust your finance guy or gal to do everything for you. I mean, you can self-manage pretty easily. That's what we do. Secondly, we're playing the long game. So, I mean, we're concerned about what's going on right now, but seeing that bigger picture, we're playing a much longer game than the immediate day or week or months. So in the long game, we don't let the current market space get us down. There's always a doom and gloom viewpoint. You read it, you understand it, you process it, you consider it, you think about how it could impact you in the short term and also the long term. That being said, the market always looks forward like a stumbling toddler, and it'll make progress towards that toy, that little shiny object, or whatever Happy Meal toy you've got, but it's also going to stumble and fall flat and land on you and cry at times along the way, which just means we should buy the best deals for now with the long-term game in mind, even when that long-term game includes the possible doom and gloom and those ups and downs. So you got to think for yourself. You got to have a strategy and sift the data, right? That sounds easy, but there seems to be a lot of data. So how do we even sift through it? There's several things that we do weekly, really, at least weekly as I make these videos, but really more than once a week. We use Kiyosaki's advice to buy what the Fed can't print. The Fed prints money, and it can manipulate that money. It can devalue it or increase the value of it. So what the Fed can't print, oil, tech, which would be a direct oil derivative, real estate and bonds. I listen to Brett Owens and his crew on the Contrarian Outlook. Brett talks everything, ETF stocks, bonds, closed-end funds. Michael Foster does talk about other ETFs and stocks, but his portfolio is based solely on closed-end funds. So I compare data points, and then I see what fits into our strategy. I look at the overall fear and greed index, and we hope to buy in fear and in extreme fear. Neutral doesn't really help you in the long run, but if you buy in neutral, then you want a steep discount. And as tempting as it is to buy in greed or even extreme greed, You can buy it, but you have to demand a discount. And we're basically always trying to optimize our buys with steep discounts. So we're optimizing the money we have. Like we want the best deal we can get, but we're also not afraid to sit on money and wait for those fear opportunities where we have more cash on hand now because we've sat on our money and we have more cash to buy the dip. Um, you have to know the herd's location. You can kind of like where the herd is, you can kind of bet the talk show guys are directing the herd towards that shiny apple. So if you know where the herd is located, you'll also know the trending advice. Currently, where's the herd? Technology. Those top 3, 5, 7 names, all tech funds are gaining ground while the rest of that market is hit and miss. So if we're not going for the shining apple, then what are we doing for the long term? Like, what are the best long term plays? Where should we go? First and foremost, where the herd is not, and into whatever the Fed can't print. So stocks, maybe, pending the portfolio. Bonds, and especially the portfolios that are laden with fixed income, because, quote, the higher for longer Fed strategy could spike the returns for the fixed income guys. You look at loans and real estate, which are like bond proxies. They flow downwind and in a similar direction of bonds. And then oil, which is the backbone to everything. So the backbone to energy infrastructure, technology. Uh, but since it's increasing in price and it's eclipsed our buy-in price point, we're not directly targeting it unless we find it in a different portfolio. Um, Utilities as well. And as Brett Owen's recent article said, utilities are also like bonds in that their prices flow opposite of interest rates, right? So with the interest rate stagnant, utility prices have increased a little bit, but with a rate drop, utilities have a I don't know, ballooning hope that they'll increase as well. And tech is bubbling. I mean, no one knows how soon that bubble is going to burst. No one knows how long it's going to take. Recent article I read said 2 to 3 years at least. But that being said, we're still not directly seeking it out. Like, I mean, we own a portfolio focused on 5G tech, and it's tempting. And we don't own that much of it, but it's already, I think, $2 higher than where we bought it. So it's tempting in the grand scheme of things, but we're also going to pay more for it now because we bought it when it was lower. Um, so it's kind of the preview data, I guess I would say. I guess I would say that doesn't exactly jive, but um, oh well, I lose my transition point. So of all the stuff I've mentioned and of my channel in general, have you ever looked at the logo for the Adaptive Perspective channel or checked out the Navigate Your Finances page on Facebook? It's a map for a reason. I like nautical metaphors. They work well with financial strategy. And Navigate Your Finances works well. My Facebook page works really well with that map, but so does honestly everything else. So instead of just labeling this a strategy like I have in the past, I'm going to label it a code. So what is our investment code? Or what is our closed end fund or CEF code? We adhere to the code unless you have a really good reason to not adhere to it. And it's kind of like what Barbosa says in Pirates of the Caribbean. The code is more what you'd call guidelines than actual rules. So here you go. 5 things that I've shrunk down from past weeks. Know your strategy, know your targets. Everybody can give you advice. And if you have no idea what you're doing, you will twist and turn, or your sales will be driven this way and that because you don't know what you're doing. Know your strategy, know your targets. Use the grander scheme data that's been synthesized into our microcosm so that we can weed through the options. which I didn't get into that this video, but if you look at the grander scheme of everything, not just the like the not just what's going on in your neck of the woods or not just what's going on in the US, if you can see the overall big picture and get as big a picture as you can, and then synthesize that down into how it impacts your neck of the woods, that's huge. Okay, but that also means you have to know your focus, and that also means you have to be willing to move away from the herd. And I have no idea who's texting me. 3, we want to buy historic discounts, which means you have to do your homework, or you can let me do the work for you, because that's really what I'm about to show you. You focus on consistent and rising dividend payers. When and how those dividends get paid matters. Monthly, quarterly, alternating schedule. I mean, we still have some quarterly payers in our individual brokerage account. The Roth is focused on monthly payers. And then 5th is you want to be mindful of the overall dividend. Our focus has been 9% plus, unless there's a good reason to buy something else. And we've broken that, or maybe we've not adhered to that, but we've broken that twice. And I can show you that, but we've broken that twice. Otherwise, everything else is 9% or above. So to sum up those 5 things, know your strategy, know your targets, buy historic discounts, focus on consistent and rising dividend payers. Oh, I'll back up. Know your strategy, use the grander scheme data, buy historic discounts, focus on the consistent and rising dividend payers. There we go. And then be mindful of that dividend yield. So let me share my screen. And let's look at some data. There we go. All right. So on the overall closed-end fund update, it's a new month. So everything got updated. Otherwise, the normal schedule is the purple, the green, and both blues get updated weekly. Targets wise, triple asterisk is a buy alert with a fairly definitive standard. It's got to be greater than double the historical discount, and it also has to be greater than the 5-year discount, unless it's a fairly new company. And if it's a fairly new or reformed company, I give that some grace. So we're at the 3-year discount, but it got bought out about 1.5 to 2 years ago. So it's going to be really hard in the last year to be double that. So it's close to that. So I give grace. 2 asterisks is a dollar cost of what we already own, and 1 asterisk is tracking for any number of reasons. So we rank them by discount, and then we rank them by asterisk. And we end up with a shrinking list, to be honest. Shift right. So current just means we already own it. So we own the dark blue, we own this blue, this is recommended, or this is recommended by somebody I trust, this we follow for any number of reasons. All of these have significant discounts. That's our current balance in the Roth account. So with all the discounts being significant, now it comes down to overall strategy. So we want monthly payers. We take this out. Next, we're going to focus on yields. Now, we've bought this fund. This is a real estate only fund. But of what we currently have, we own this in both funds so in the individual and in the Roth, we own both funds have that closed-end fund at 50 shares. So we've bought this in the past because it is still the most significant discount. And what that means is we rank these by discounts again at, we'll say 50, I get it's 52 and a half, but at 52% off, it's like paying 40 cents, 48 cents per every dollar invested. Versus if you find one that's break even, these two funds are still, so every dollar is a dollar invested versus this fund is $1.62, almost $1.63 for every dollar invested. So this on this end of things at a 52% discount, it's like getting it for 48 cents on the dollar for every dollar invested. So real estate with not everything operational and online in a higher interest rate market, right, with coming hopeful coming interest rate cuts should do well. But we have 200 shares of it and are not going to buy any more of it right now. So that leaves this. Of what's here and how I went through this myself earlier, knowing this and yes, and yet also ignoring this. The goal is to not pay this much for fun from my angle. I mean, the overall cutoff is $16, but the goal is to not pay that much of what they're invested in. We can buy similar for cheaper elsewhere. Um, of what I explained this to myself earlier, it's in the grander scheme of things. Okay, we bought, and this is inside our Roth. So inside our Roth, we bought MBXG at 11.40 at 11.4. It's currently almost $2 higher at 13.3. So if we bought a second round of it at 13.3 plus divided by 2 because it's equal shares. I like buying sets in 50. That makes equal share. If I didn't buy it in sets of 50, it would make this a little bit off. But in equal shares, that would be the average price per share, right? And at 12.35, like if I'm not going to buy, there we go. If I'm not going to buy that right now, and I get the overall thing, like it could go to 30, right? And 13 compared to 30 is definitely cheaper, and you're getting, I mean, you're getting the dividends and the capital increase. You're getting all that. But if I'm not going to buy this, then I'm not going to buy this right now. And having looked at this portfolio, I like this portfolio better. This portfolio still doesn't make sense to me. It's a term fund. It's only going to be in existence another 7 years. Whenever it liquidates, it'll liquidate at whatever the current net asset value is, which that's fluctuated recently. I get how millennials can be drawn to it based on how they're built. They're looking at renewable energy, all of which requires oil in order to make it, so manufacture it and also build it. But they're also not invested in oil at all because from their standpoint and their portfolio standpoint, oil is bad. But all of their renewable energy requires oil in order to be made, in order to operate, in order to repair, in order to, right? So it just doesn't make sense to me. And between these two, I mean, I've already got ETW stuff pulled up top. I like this one better. So that leaves us with 5. Now, 4 we own, 1 we don't. And our overall um, earmark target system code, however you want to say it, is we're looking at high fixed income, bonds, loans, and real estate, or stocks pending. So this is bonds, but it's not high and fixed income. This has some bonds, but it's not high and fixed income. This has bonds and is high and fixed income. This has bonds and is high and fixed income. And they're on polar opposite of overall company assets. This is pushing 2 billion now. This is around 40 to 50 million now. I mean, they are on complete opposite planets in returns of total assets. However, they're still highly invested in fixed income or still highly allocated, however you want to say that, in fixed income. And then you have this one, which is all stocks. And what I wanted to show you, done with that, talked about that. So this is ETW on face value. Pause the screen if you want. So in a high rate market and with a hopeful rate cut, my hope would be the dividend continues to rise. I don't know how much it will rise, but it would be nice if it rose a little bit. And of what's listed on here, it's that S&P 500 top 7. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet. Um, but if you wanted an even bigger look into their portfolio, you look at Morningstar, right? No fixed income, a general portfolio in a can, less on real estate. That's okay. We've got other funds for that. All stocks, and it'll show you the weights of the top 25. Compared to this one, which is overkill on fixed income and loaded with corporate bonds. You can close that one. But if you really wanted to see what was in the portfolio, you would go to their actual webpage and dig into the entire portfolio. And I will scroll through this. I don't, maybe I'll scroll through it all, but, and feel free to pause and read as you go. It's not just that they're invested into the top, uh, top S&P. It's, you've got utilities and banking and all this other stuff. And it's all what the herd doesn't see, or maybe what the herd doesn't understand, is you have the outright tech, right? Like you have the companies that are known for tech, needing tech and pushing tech. But all of these other, like all of these other companies need tech as well. And our society has become so tech dependent that all of these companies require technology integration and require top of the line software, require 5G networks, and they all are tech based. Yeah, interesting. Pepsi and Coca-Cola. They have Home Depot and Lowe's. Um, Target and Walmart and Costco, I believe. Yeah, Toyota and Daimler. So it's endless. And yes, there's a final end of the portfolio, which I guess I can keep scrolling because, yep, there we go. So all the way back to the top. Um, for a guy that's been, I mean, you can watch my videos, but for a guy who's been bonds and real estate and fixed income for a while, this is tempting because it's an indirect investment into technology when the market is still down, and it's tempting. The problem becomes that's what we have right now. So, of this list, if we bought anything, which I'm hesitant to buy because we're in that neutral zone of the fear and greed index with it finally tipping towards greed. And this would be the bargain area. Like it, all of these, all of these, honestly, this is not the lowest it's been. This is close to the lowest it's been. That's an up and coming company. Um, so if we bought anything, it would be that. And the math on that is just one minus the other. We still have a remainder. Portfolio in general makes about 93 a month. With that, it would add like $1.40 more. So now we're making 95 a month. So we can go back to there. So just so you can see, so puts us at 140, which would not allow us to buy another 100 set the next month, maybe a 50 set. Yeah, it would, if we wanted, we could buy a 50 set. Okay, but the long-term strategy, this is our individual account, which we will gradually sell off to help fund this Roth account. This is taxed. This is not taxed. You can add as much as you want. You are capped at adding 7 grand a year. But again, this is taxed and this is not taxed. So long term, these dark blues, I don't plan on selling anytime soon. Well, I take that back. So interesting. So interesting how this goes. It should take the same form of that one, this double, and it doesn't. That's frustrating to me. Um, Still won't do it. Interesting. So these companies should do well with a rate cut, like everything else, but they're heavier on the bond portfolio side. So I want to keep them and watch them rise. Um, this fund, we didn't have a choice in it. I guess you could say we had a choice and that we had to vote on it, and I voted against it, but the vote passed anyway. But it moved from closed-end fund to uh, general mutual fund, and is still getting flushed out. Like I don't, they paid a monthly dividend so far. Um, and we, yeah, that's neither here nor there. But since we're trying to focus on closed-end funds, owning a mutual fund in this portfolio doesn't bother me, but long term, it's just not where I want to be. So if we sold this and used it to help out our Roth fund, that could be beneficial. The other option is to sell this fund, or maybe to sell them both at the same time. We'll see. It's kind of the overall strategy. So if you believe we're in a recession, history says people push money into the necessities and healthcare in recession, and this is a healthcare fund. If you think we're in it and coming out of a recession, kind of like a quiet recession, If you think we're already in the recession and coming out of it like Michael Foster, then I would cut our losses here, which I guess there are no losses, but I would cut the money here and reinvest it elsewhere. But this other stuff, so oil, energy transfer, technology, bond fund. I love this bond fund. Uh, Oil, energy transfer, and real estate. We would keep them until the market turned and started to slide in favor of something else. So back to strategy. If we sold this fund and more like if we sold this fund, and then maybe if we sold that fund at 1800, there's our video, then yeah, we could pick up 100 shares easy, see where the market goes, and then buy again. So, but as it stands, of what we have, if we bought, it, as it stands, if we bought anything tomorrow, we would buy this fund. That said, even though it's towards its lowest, I'm that fear and greed index chart is actually, let me show you that chart again. I'll come back and share again. So this is the current fear and greed index with neutral. And sometimes this chart doesn't make sense to me because if you look at these boxes, not all the data, but if you look at the boxes, extreme greed and extreme fear. So if we go up here, extreme greed compared to extreme fear leaves you neutral. Same thing, extreme fear and extreme greed, that still puts us at neutral. And you have confirmed that, neutral. But now you have greed and greed. Just based on that, we should be over here. But based on however their algorithm factors out the data, we're still in neutral. So when the algorithm, either by visual or just by looking at the categories, gets into greed, yes, we can scoop fantastic deals. You can buy stocks, you can still buy stocks, closed-end funds, whatever, lower than what they've been and get a fantastic dividend. That's true. You have to demand the discount. From my standpoint, you're looking at the overall numbers. Like if you're getting a great discount and it's $3 higher than what you've already bought, that may or may not be a good deal for you. But if it's close to the bottom of that price index, and you're getting an amazing discount and you're getting an amazing dividend, then that's a good deal. That said, it makes me I don't want to say that I'm not cautious. It makes me cautious to invest in this area because with more money pouring in, it's still going to elevate the market as a whole for the most part, but you're still going to have those downtrodden sectors, and that's really where you can scoop. So like if the S&P is up because people are pumping money into technology and it pushes everything into greed, that doesn't mean the rest of the market is in greed territory. So I don't know, maybe that sounds like I'm waffling. Not my goal to waffle. Not my goal to waffle. So tomorrow, it's not our plan to invest right now. Um, and honestly, tomorrow I'll be in my house working and seeing how the hurricane does rolling through. But we'll see how things go, and maybe we will invest by the end of the week, and maybe Maybe we'll sell some funds by the end of the week out of the individual account. Who knows? So to prevent myself from waffling anymore, that is what I got. So my top three for the week: FCO, CIF, and ETW. If we're investing, we only have the funds to invest in CIF, but that fits the metric. If we had the money to invest, we would probably invest in all of them, or we would do some. Mm, I'll backtrack that a little bit. If we had the money to invest in all of them, we would still hold back so that we could pick. We don't want to like throw everything in now. Much rather get like an average, 100 this month, maybe 100 next month, unless we just hit another bottom of the market. So if you like my content and if you can deal with my waffling, but if you like the content, consider subscribing to my channel, hit the like button. It really does help push videos out. And then if you can look at the overall grand scheme of your finances, all of us are working towards a specific end. Maybe yours is the 65 plus retirement plan with your company. Maybe you want to retire in the next 5 to 10 years. Wherever your destination lies, you will not reach that deserted island and buried treasure chest without knowing where you're going and why. Like, why are you even trying to get there? Like, not so much why do you want to find it, it's why are you even bothering with being on this journey? Your dreams will not happen on their own. And because of that, you have to have a battle plan and an approach, right? You've got to have a reason to do it all. You've got to have an attack plan. You've got to attack it with purpose. You captain your ship, I captain mine, but you captain that ship. You can let it be wishy-washy. You can let it be thrown by the waves and driven by the current, or you can actually pilot your ship and captain your ship to where you want to go. You can direct its course, and it is so much easier than what most people will tell you. So if you can figure out where you're going, where your dreams lie, if you can figure out where you're going and why, that's huge, because your dreams aren't going to happen. Like they're not going to manifest. If you could spend 30 minutes in meditation every day for the rest of your life, that's not going to manifest your dreams and have them land in your lap like an Easter basket. It's just not going to work. But if you can lay out your battle plan and lay out your map so that you can get from where you are to where you want to go, now you have a plan in front of you that you can follow. And your job becomes getting from point A to point B, and honestly living beyond point B. Because when you reach that island and you hit your treasure chest, it's not like life stops. It's not like you die on the island. You get back on your boat and keep going. So if you want more info on that, then head over to Facebook and check out my page called Navigate Your Finances. So whatever you have for the week, I hope it goes well. I hope you're not having to deal with this hurricane. We are not stressed, but it's still the same, kind of watching, waiting, seeing how the weather goes. I hope you have an easier week than a hurricane. And yeah, if you have no idea what I'm talking about, no idea where you're going, come find me on Facebook and check out what I'm posting there. And let's see if we can get you going on helping you get to that treasure island, or that deserted island with the treasure chest. Know where you are, know where you're going, and why. And then it becomes your job to pilot the ship or captain the ship between point A, point B, and beyond. So I hope you all have a great week. See you on another video. Bye bye.